Micron just printed the best quarter in its history, and it trades at a single digit forward earning multiples. For most companies, cheap and growing is a gift. For a memory company, it is a warning level. Memory is the most cyclical businesses in the tech, and the lowest multiple in the sector always show up at the top of the cycle and not at the bottom. Stock is up roughly 8x in last year. The market has already paid up. The only question that matters is this: are these peak earnings or a new floor? That's what today's video is about. You have seen the headline numbers by now. Record revenue, 5 to 6 billion of beat, 85% margins, 50 billion guidance for the FQ4. Here is the line from print that actually matters to us. DRAM bit shipments barely moved low single digit. DRAM prices jumped in the low 60s percentage in a single quarter. NAND prices mid 80s. This quarter was almost entirely price driven, not the volume. That's the engine, and price is the thing that can mean revert. Hold that thought. We will run through everything else in this video. Let's have a look at Micron's annual revenue over the last decade: 20 billion, 30 billion, then back to 21 billion. Then fiscal 2023 collapsed to the 50 billion with a $5 billion operating loss and the negative gross margin. That is the Micron business cyclicality: lumpy, violent, and unpredictable. Now the other side. DRAM revenue has gone up roughly 10 times in 3 years. Data center revenue alone crossed 25 billion this quarter, 100 billion ARR. Cloud memory up 300 plus percentage. Core data center up 600 plus. So you have the most cyclical business in tech posting the best number in its history. The bull case is that this time the shape of the cycle changes, and the reason it might be the announcement that ran alongside these earnings. Micron signed multi-year 16 SCAs. Management calls them an industry first. Here is what they are and where the catch is. They are take or pay, non-cancellable 5-year deals through 2030. The customer pays price as a function of volume, whether they take the chips or not. They cover about 20% of Micron's DRAM and one-third of its NAND, and when fully signed, half or more of the total company's revenue. 14 of the 16 SCA parties carry a floor price, minimum near $100 billion, and customers are putting about 22 billion in cash deposits. The deposit is the tail. Nobody prepays billion for a commodity unless they are scared of not getting supply. And the floors, management says lock in margins above any peak Micron has ever printed. A commodity maker putting a high floor under its worst case, that's the structural change argument. Now the catch. The biggest deals cap the ceiling at today's prices. Around 40% of revenue ends up fixed or capped near current levels. Micron is trading its upside tail for downside protection. The only leak in that cap: pricing resets quarterly, and new generations like DDR6 and the next SBM earn fresh premiums the ceiling does not cover yet. Bottom line, these are not a magic wand on the cycle, they are insurance. They dampen the troughs and cap the peaks. And by Micron's own slide, 60% of revenue is still priced on the open market. Let's get back to where we started, the valuation. On forward earnings basis, Micron looks like it trades around 8x, and on TTM basis, it trades at 20x. Both are true. They are just measuring the different cycle point. This stock has swung from negative earnings at the trough to the low double digit multiples near the top. So single digit valuation on forward basis itself is not cheap. It's what a peak looks like. If the market is right there, then earnings will fall. If the SCAs make these earnings durable, if half the book is contracted with the floors above the prior peaks, then a single digit multiple on a de-risked business is genuinely mispriced and the stock needs to re-rate higher. On a flip side, if this is just another cycle top dressed up in a contract language, then the low multiple is correct and you are starting at a value trap after a 8x run. The bet you are making on Micron is not bet on cheapness, it's bet on the durability. Be honest with yourself about which one you are. Second, a structural change: what Micron does with the cash. Management committed to returning 100% of excess free cash flow. Buybacks are the main tool, and the dividend just raised about 30% is secondary. Management endorsed if free cash flow holds, that's enough to retire roughly 10% of a share count each year. That's a real tailwind for per share value. Let's talk about risk. Four risks. One, the cycle. 60% of revenue is still spot priced, and the floors have never been tested through a real downturn. Yes, the contracts are legally non cancellable. That's genuine. Stronger than past memory deals. But legal and practical are two different things. When a key hyperscaler is sitting deep underwater on a contract, supplier have historically tend to renegotiate. We won't know the floors hold until a downturn actually tests them. 2. China and CXMT. Just in, Apple is lobbying US government for clearance to buy DRAM from China's CXMT, a company on the blacklist by US government, specifically to reduce the dependence on the Micron, Samsung, and SK Hynix. CXMT is scaling from 200K to 300K wafers a month, with revenue up around 700% YOY. And Micron has been lobbying against exactly this access. A state-backed fourth supplier is the one thing that breaks oligopoly pricing discipline, so watch it closely. 3. Samsung inside the oligopoly. Samsung is spending aggressively to close its HBM gap. If it catches up, Micron's pricing is in the highest value segment narrows. Fourth, concentration. DRAM is three-quarters of revenue, and the highest value data center demand sits with a handful of hyperscalers. Narrow customer base, narrow product base. None of these are fatal today. All of them are reasons the market refuses to hand this stock a durable multiple at. On 25th June, Apple hiked prices on Macs and iPads by up to 20%. The company attributed the changes directly to sharp rises in the memory and storage component costs. Tim Cook called the shortage a 100-year of flood. DRAM prices have nearly doubled in one quarter, with another 50% rise expected. As per analyst, memory could make up 45% of an iPhone's build cost by 2027. That matters a lot because of who said it. Apple. Apple has the deepest supply chain on earth and absorbs cost shock for years. When Apple stops absorbing and starts charging customers, that's not a spike. That's a company concluding the price has found a permanent floor. And Micron's own demand signals line up with it. HBM is sold out now just through this year, but the multi-year visibility now. Management pulled forecast its forecast for the HBM market to cross $100 billion to calendar 2027. It's widening beyond HBM2, enterprise SSD. Revenue more than doubled in the quarter. And Micron pioneered low power DRAM and the SOCAM form factors for AI servers, high value, stickier sockets than commodity DRAM. Layer on agentic AI pulling in CPU and storage racks, and physical AI on the horizon. A humanoid robots carry roughly 10 times the memory of an advanced car. If even parts of that arrives, the demand side has years to run. So here is where I land. The business is in the strongest position of its life, and the SCAs are a real attempt to change the shape of the cycle, not a gimmick. But the stock has already moved 8x in last year, and a single digit multiple on a record peak margin is not a free lunch. I am not chasing it here. My plan is specific. I want two things before I buy. First, a meaningful pullback. I am not chasing up here. And second, the evidence the market is willing to assign a durable double digit forward earnings multiple, because that's the market itself confirming the SCA re-rating thesis instead of me hoping for it. And here is what would prove me wrong in either direction. Bullish confirmation. DRAM export prices hold or rise through the second half of 2026, proving this is not a peak. Bearish break. The CXMT request gets approved or spot prices roll over before the SCA floors are tested. Either one and the durability thesis is in trouble. I will be watching the floor prices, the spot prices, and the regulatory changes in that order. This is not an investment advice. Do your own research. If this framework helped, please subscribe. Thank you.